This is Nate Dodson, and you're tuning into And This Is Why, the podcast show. A show where we help you take your business to the next level. New episodes every week streaming on your favorite streaming platforms. Enjoy today's episodes. Hey, thanks for joining us today for This Is Why, the podcast, where we're talking to one of the most amazing entrepreneurs that I have known, but I've actually known him for, almost 20 years. One of my best friends, best clients. We worked together, we're partners together, and did so much. But today he continues to grow, continues to prosper in some of the most amazing directions and amazing ways. So really think that you're in for a treat to learn about one of the best deal makers of America and share a little bit about his path and how he did what he did and where he's going. So please allow me to introduce you to Mr. Eric Mattingly.
Appreciate it, Nate. Thanks for having me on.
Absolutely. You know what? It's been a while since we caught up, and we all have our different paths and where we go in life. But one of the toughest reasons to get a hold of you is because you travel so much.
Yeah.
So I know you're going to Bali or somewhere.
Bali, Indonesia.
Going to Bali. How long are you staying and what are you doing out there?
We're going to be there for 3 weeks, and my wife and I, we travel 90 days a year. And you remember when I had a lot of the health issues back in 2014. I lost my father when I was 15 years old. He was 49 when he died, and then oddly enough, at 42, I had some real serious issues and was in the hospital for 90 days, and I almost died. And I, at that point, I really realized what was important in my life, and I had a lot of regrets, and I wasn't thinking about, how much money did I make and what was going on. I wasn't answering emails, phone calls, and it was a big struggle and challenge, as you know. You saw me go through that, and at that time, I told myself, why am I working so hard, And it's not that I could have just disappeared from my business for a year at that point or whatever, but I could have been on a vacation for 90 days, literally, and that's when I had a paradigm shift of really what is the most important thing that all of us has, and it's time. And for me, I committed at that point, if God was going to let me survive, that I was going to commit to travel 90 days a year, and I've been doing that every year since. And sometimes work follows me, but the nice thing is I can pretty much work from anywhere, but I try not to take work with me when I go on those trips. And this particular trip was one of our honeymoon destinations that got canceled because of COVID, and so we're getting an opportunity to go, and so I'm really excited about that.
That's amazing. And I know quite a few really like technology entrepreneurs that have picked up and moved to Bali for a large reason of it's beautiful, it's safe, and it's unbelievably cheap. Enjoy your $3 meal. Your
thank you.
$15 hour-long massage. Like it's I hope you really have an amazing time.
I am going to abuse all of those things.
I would expect absolutely no less. So, but traveling back to the start of your journey, and I really want to make a point for everyone that's listening. Yeah, you started in a different place with martial arts.
Yeah.
And that was really the start of your entrepreneurial journey.
Right.
Could you tell us a little bit about kind of where you started and where really what you learned and
Sure.
how you grew?
Yeah. So, I've pretty much been an entrepreneur all my life. I've had very few actual jobs where I worked for somebody else. But my first real business was a martial arts school, and this was back before the Ultimate Fighting Championship was ever out. And I called what I was doing freestyle martial arts, and I started martial arts when I was 6. I've been in martial arts all my life. I still teach. I still train.
10th degree belt over here.
Yeah.
Don't mess with them.
Yeah. 2019, I got promoted to my 10th degree grandmaster's level. I have 3 main instructors that I've trained with over the years. I still train under all of them today. They still train under other instructors. So I think that's important, that, part of being a master, in my opinion, is being humble and always trying to learn. And I try to learn something from everybody I'm around, not just through martial arts. I mean, I'd say half of everything I learned about, the investment industry and putting deals together and private placements and syndication, I learned from you. I really value the knowledge that I gained from you, and how to structure deals, and, what you can do, what you can't do. And, I got bitched out many times by you, trying to keep me, in check and doing things the right way. And since that time, I started my martial arts school when I was 28, and I met a lot of really valuable relationships that have actually impacted what I'm still doing today. And I apply a lot of those principles to what I do in the investment business that I actually learned through martial arts.
And I think that's a huge thing for everybody to really know and understand is education is important, but the people that you get to know and learn from and grow with and grow from is truly one of the most important parts of the overall journey.
Yeah.
Because none of us are one-man army. None of us come out as the PhD and whatever it is. It's about surrounding yourself with the people that have the knowledge, that have done it in the path, that have passed, that have already kind of created the path for you to do it your own way. But don't think you have to be that unicorn of,
right,
I'm going to change the entire industry. Like, why don't you do what the successful people have done first?
Right. Yeah. I relate a lot of what I do in business today to martial arts. It's been a big impact on how we do things, the way we do things, the way we treat people. Martial arts is about having, dignity and being able to be tenacious and not give up and not tap out. And, I fought professionally for about a 4-year period of time, and through competing, a lot of people want to fight. It's very different to actually fight. So whether you win or whether you lose, just the fact of preparing for a fight and being willing to go and face your fears and face an opponent. And it's no different in business. I mean, you've been with us since the beginning and seen everything that we've done, and all of the challenges and things that you face. I mean, it's, you can get beat up in the ring. You can also get beat up in business. And the people that have experience are the ones that keep getting back in the ring and learn from their mistakes and try to improve. And so that's kind of what I did. It's kind of long story short. I had a lot of injuries because of all the fighting, and I decided that one of my students actually owned an oil and gas company, and he said, and I'd been investing in real estate, learning to invest in real estate since I was 18. Started doing real estate when I was 28. And then that's when I started competing. And then by the time I was about 31, I had a lot of serious injuries. I had over 10 herniated discs. I mean, my history, but I've had close to, 30 serious injuries and surgeries. That's what took me out of the martial arts game. And then went into the oil and gas business. And my friend said, look, if you want to do anything on any significant scale beyond flipping 1 or 2 houses at a time, you have to learn how to work with investors and put investments together. And
the secret of OPM.
Yeah. And at the time, I was using like credit lines and credit cards as the OPM. I wasn't working with other people and their investment dollars and things like that. And so I went into the oil and gas business knowing that I wasn't going to like the business, but I learned how to communicate with investors. And I did that for about 2.5 years, and that's kind of when I went out on my own and went into real estate and basically syndication full time at that point.
I love it. Well, we got introduced together, and it was a long time ago, and it was with a company capitalization.
Yeah.
And so I'd like to hear your thoughts. You've raised money for real estate. You've raised money for businesses. You've raised money for oil and gas. And I know that kind of the pitch, the story, the incentives are kind of different based on the different categories.
Yeah.
No one knows this better than you. Could you kind of speak to that a little bit?
Yeah. Well, with oil and gas, I mean, it's, investors, for the most part, it doesn't generally work out very well. And
There's a massive $150 million Ponzi in Texas that just got taken down.
Yeah. I wasn't aware of that, but the company that I worked for that was owned by my friend is still in business this day. They have a broker dealer. They do everything by the book, and they've legally probably lost $2 billion of investor capital in high-risk oil and gas drilling projects. And
these are the reasons why Crowdfunding Lawyers, my law firm, does not represent oil and gas deals whatsoever because of that statement right there.
Yeah. You're getting into all cold calling. You don't really build relationships with people. You don't want to be close to people because it's a high-risk investment for the gambler-type people. And you're disclosing to these people on every single phone call, every single communication, this is a high-risk investment. You can lose all your money, but yet these people would still invest. In fact, the more you would tell them not to do it, the more they would do it. And it just didn't make any logical sense. And you had the difference.
Emotion.
Yeah, exactly what I was going to say is the difference is people that invest in oil and gas are making emotional buying decisions versus real estate investors and people that invest in businesses are making intelligent investment decisions. And but I learned a valuable skill. I went in there with the idea I was going to learn something and I was going to go apply it to, I wanted to be a full-time real estate investor and be a professional investor. So I was there for a couple of years. In fact, the owner and his wife were both black belts under me when I was in the martial arts business, and it changed my life, and I appreciated all the knowledge. But just, raising money for super speculative investments like that was just not something that set right with not only me, but, a lot of the people, in fact, all of the people that, I worked with, have pretty much all gotten out of the oil and gas business and gone into other things because of the bad experiences to the investors,
All right. And now, I know that there's even a difference between real estate and a company.
Yeah.
What's your opinion on really the distinction between the sales process and the investor motivations between that company versus real estate?
Yeah. Well, when, you and I met, the group that we're working with, they were doing it was commercial real estate, because at this time I'd only, when I met you, I'd only been doing single family real estate investing. We later actually started a real estate investment education company teaching people how to invest in single family real estate. But that's where I got exposed to commercial real estate and business capitalization, because they were acquiring the buildings and they were also funding the businesses that would go into those buildings. And, I'd say there's, you can have a great investment with a bad operator and you have a bad investment, right? So for us, we don't look for deals. We look for experienced quality operators that we can go into partnership with, whether it's in real estate or whether it's in business. But with real estate, obviously you have a tangible asset. And if you underwrite it conservatively and you manage it properly, you've seen all the various different challenges, not just with us, but all the people that you work with. And if you're a good operator, really all you are as a professional investor is a professional problem solver. And you can get out of a lot of those things on a real estate deal. There's more options. With a business deal, if there's no building attached, you are investing in the operations of the business. There's more risk involved. And if you are going to look at investing in businesses, really you want to have, something that's got an established existing track record. If you do any kind of a startup or new concept or new idea, there's really nothing to look at and as far as operational history and things like that. And that's one of the reasons why we don't work with any, first-time real estate investors, first-time business owners. We want somebody that wants to have a repeatable model that's going to open, that's going to do project after project after project, or business after business after business, versus just funding a single business with a single group.
I'd like to add a few comments to that, because I agree with you 1,000%. Now, when it comes to the startups, the startup businesses, they have the highest risk, generally the highest reward expectations.
That's right.
With the highest failure rate.
Yeah.
And kind of based on my experience doing thousands of deals at this point, in the startup world, if you're trying to get going with, you got this new, we're going to change the world type concept, fantastic, but those investors are expecting 10x their money.
Right.
They're not
They should get
for, and they absolutely deserve it for putting their faith and belief in the startup entrepreneur.
Yep.
To try to sell somebody on you're going to get a very attractive 13% annualized return someday when we happen to make it.
Yeah.
You're never going to get those people sold on a startup business.
Exactly.
But if it's a franchise, or as you say, the serial entrepreneur that is just doing location after location after location, that has the proven track record, now all of a sudden, a 13%, and you've been doing it and you have a track record, I have no reason to think you won't do it again and again and again, all of a sudden becomes an attractive investment.
Yeah. Just to kind of, expand on what you're saying, for us, we have kind of a box that we look at, sort of our minimum returns, parameters that we want to be able to get on a real estate deal, and a different box if it's on a business deal. Like with real estate, multifamily, retail, commercial strip center, whatever, we want to have a range of return from low to high, a 10 to 20% range. Obviously if we do better than that, that's fantastic, but that's kind of our threshold. And generally what we do to protect our investors is we'll put a performance hurdle on the back end. So at the time of sale, if you haven't met at least, and on real estate deal, we use 10%. On a business deal, we might use 15 or 18% as a performance hurdle. And that way, at the end of the day, when you go and sell the property or whatever, at least the investors are standing in front of the sponsors, and the sponsors may have to be diluted to make sure they hit that minimum above market return. On a business deal, we're generally looking at on a kind of a base case or downside scenario, we want to be able to hit a 20 to 30% return, and we'll usually put a performance hurdle of 15 or 18% on the back end, just to make sure, because it is more risk. Investors are looking for higher returns, but we also don't work with any startup people. So there's generally something to look at to really make an assessment that you should be able to meet that criteria.
And I just want to clarify very specifically what a performance hurdle means. So it's on the back end of a deal. You look at what cash flow went to the investors, you sell the assets, what cash flow or distributions go to the investors. Now look at the performance hurdle. And if the investors didn't get at least that return on their money overall, then the sponsors, the management, will reduce their share to make sure that the investors at least get a good return. What's the difference between a performance hurdle and a preferred return?
Preferred returns, we will use preferred returns on like a development deal, because it generally will take a longer period of time. And when we do a preferred return, we generally don't do a performance hurdle. So for us, it's either a preferred return or a performance hurdle. So if we're going, and if you do a preferred return, we also will do generally a less of an equity share. And so a preferred return just means that all cash flow that's coming from whatever source has to go to the investor first. So if you have an 8% preferred return, all of the income and distributable available cash is going to go to the investor. And then anything over that is going to go to a split between the investor and the sponsor, versus a performance hurdle, which again, generally we do on deals that we don't do a preferred return. And we're just doing a straight equity split. So if it's a 70-30 or a 75-25 investor sponsor split, that means along the way, both the investor and the sponsor is getting a percentage of the cash flow. Then when you go and sell, if the investors between their distributable cash after the return of capital and their share of the gain on sale doesn't exceed that 10%, performance hurdle or whatever, then the sponsors are going to have to reduce or eliminate all of their share to make sure they hit at least that minimum threshold. You're the one that actually taught us that.
And let me kind of explain, just for anybody that's listening, kind of the way that I like to look at it is you have a preferred return and you have a profit share, and they're like levers. And as you reduce the preferred return, you increase the share of profits. And it really doesn't matter what that share of profits is, as long as it makes sense to the deal, it's sellable. And if it's too small of a percentage, because it's a business, because there's all these partners, I actually don't think it's a horrible thing as long as you have a performance hurdle at the end of the day. So between those three concepts, it's really easy to structure where it's incentivizing to the management that there's profits coming to you, or incentivizing to the investors to ensure that their interests are prioritized as well. So that at the end of the day, everybody gets treated well as long as the deal is going okay.
Well, and just when you suggested us using that, earlier in my career, and we had, a few projects where there were some challenges, and even though it wasn't in writing, the sponsors were simply reducing their share to make sure that the investors were meeting and in some cases even gave up all of our share. You were part of those deals with us and structured those deals, and
lost my back end as part of those.
But we were doing that, but we weren't putting it in writing, and we're telling the investors that we would do that, but that's not what the legal document said we had to do. And that's when you suggested, why don't you just put in writing a performance hurdle? And quite frankly, it's a sales pitch. We use that so the investors know we have their best interest at heart. We're not just telling you we're going to do something. We're putting it in writing. It's in the legal document, the PPM that you signed off on, and so did we. And that's actually helped us on, we get a lot of feedback on that. Investors really appreciate the fact that you're willing to do that.
Well, I want to go back to what we were doing when a project didn't go well, of just voluntarily giving up the back end to make sure that the investors are taken care of. And honestly, to the bottom of my heart, I'm glad each and every time that had to happen. I also give, just ethics at the end of the day, the morality and ethics of doing what's right.
Exactly. Kind of going back to what I was saying about martial arts. That's part of what martial arts is all about: doing the right thing, helping other people, putting people in front of you, protecting people in whatever capacity. In this case, it's against a financial loss. And it's amazing. And, hey, knock on wood, there's some wood over here. We didn't have to do that a lot of times, but we have done it many times. And it was the right thing to do, whether it was in writing or not.
Completely, 100%. And I'm hopeful that never has to happen again, because everything is always wonderful.
Yeah.
But it has definitely been an interesting real estate market. I know you're heavily focused on that.
Yeah.
What are you seeing with the interest rates going up? There's some expenses that have been going up. It's also creating opportunities in the market that weren't there before. Kind of what's your thoughts on what's going on in the real estate world right now?
Yep. As far as real estate goes, we do a lot of multifamily. We've had a lot of success in multifamily. We've had, when struggles come up, we're familiar with how to solve those problems in multifamily. I'd say one of the big, other than a poor operator, as far as just the risk on a real estate deal, especially a commercial real estate deal, generally has something to do with the financing. On some of the earlier deals, we had a great deal and maybe we had a bad loan, and then, that caused the challenges, and sponsors had to reduce or give up part of their share or whatever to make sure the investors were okay, because you couldn't get out of a loan because the prepayment penalty was too high and all these other things. Now what's going on with the interest rates, luckily, we only have the 2 projects that are having some challenges because we generally, on a acquisition deal, we do acquisitions and development, but on an acquisition deal, you're going to generally want to use a commercial bridge loan that you can get out of without a prepayment penalty, so you can do a refinance and do a return of equity to investors and then put a Fannie or a Freddie Mae loan on there. And your best rates when rates were good were on floating interest rate loans. And so we have 2 properties that we're about to have to refinance. And, it's been a bit of a struggle because they were great loans when we got them, but it was a floating rate loan that didn't have a cap. So 2 of those loans are up over, at around 11% right now. Well, that completely consumes all the cash flow and can cause you to be upside down. So with the interest rates where they are, the challenge is doing new deals. So we haven't done not one new acquisition deal this year as a result of just where the interest rates are. We have done some development deals that are HUD deals, and we're still getting good financing terms that still make sense. And so we're still doing multifamily, but maybe a fourth of what last year we did. We did 7 multifamily deals. This year we've done 2. And they were both development deals. And so
I can tell you from our experience in the market for the first quarter of the year, because of the rising interest rates, the lenders were renegotiating. We had a ton of deals in the pipeline. Not a single one of them closed 100% because of the lenders.
Yeah. Well, that happened to us on 2 deals, the last 2 deals that we did, and right as the interest rates last year where they really started ticking up, and we were on one deal. It was a Thursday, Monday was a holiday, and we were to close on Tuesday, and they tell us on Thursday that to close, they just decided arbitrarily that they were going to give us $1.5 million less in loan proceeds, and that we're supposed to just crap out $1.5 million in 1 business day, because Monday was a holiday and Tuesday was the day to close. And luckily we have a good, professional investor network that we were able to go to, and we were able to make that happen. But we had to change. It was a 75-25 split. And we have all of the capital raised and ready to close, and all of a sudden they changed the terms. So really what that did was create a dilution to the investor. And so in order to not go and offer a right of rescission to all of the investors that, hey, you just got diluted by 5% or whatever, we just changed the terms to an 80-20 split, which gave them a slightly better deal, even with the additional equity. And we just amended the PPM, and we didn't have to offer a right of rescission, but we had to change the terms of our deal, like right before the closing table. And that happened to us. That was a pretty big deal. That was supposed to be a $10 million equity raise. It wound up being an $11.5 million equity raise. So it was a lot of money to raise to begin with. And then right at the closing table, you're going to do that. And then we did a smaller deal, and they did the same thing. And we had to delay the closing, and the buyer, thank God, was cool about it, because they could have just said, no, because we were out of our extension time. But we went ahead and got the deal done. But it was the same thing. We had to bring more money to the table, change the terms on the deal. It just wasn't quite as big as that, but that was a real challenge.
And that's exactly what we've been experiencing. Like, the sellers are understandable.
Yeah.
I mean, it's happening across the board, and if they try to walk away, maybe they keep a little bit of earnest money, but guess what? They've got to start the process all over again.
Yeah.
And with the increasing interest rate,
they're going to have to reduce their price.
Exactly.
Yeah.
So it did seem like they were open to delay closings, and ultimately that's what happened with most of them.
Yeah.
First quarter, nothing closed, time to renegotiate. Everybody kind of has to come back to the table all over again. And as long as it still makes sense to all parties, they're eventually closing.
Yeah.
But seeing a contract that should have been closed in 90 days, now it's 6 months down, and they're still struggling to come together.
Yeah.
And fortunately, what hasn't happened are lawsuits over the earnest money. Because what we have absolutely found quite a few times is you have the financing contingency, and the loan meets the financing contingency until it gets renegotiated. And now all of a sudden that same loan that met the financing contingency no longer does.
Right.
And the seller's saying, well, you breached the agreement. I'm keeping the money.
Right.
And the buyer's saying, no, I didn't.
Yeah.
And
the thing that's amazing is you have no legal recourse against the bank. They can just arbitrarily decide to do that, and there's nothing you can do about it.
And this is America.
Yeah. That's what really just dumbfounds me. There's no liability on something like that, and then they could cause people to lose the deal, lose hundreds of thousands of dollars in earnest money that went hard, and a seller decides that they do not want to be flexible to you, and then just pass and go to the next guy, and you can't do anything about it and go after the bank.
Fortunately, at least in this environment, there's not a lot of earnest money going hard day one anymore.
No,
it just
it's not going on now. And to your point earlier, you were saying, there's problems, which we're talking about, and then there's also opportunities. And the challenge we've had, that there is some real opportunities with being able to acquire property. Most people are not going to want to sell into this market right now, and those that do generally are doing so because there's a reason or some motivation to sell, knowing that you're going to probably have to, reduce the value because of the high carrying cost, and will make it challenging to make the deal work unless you gave a discount. And but even though that's an opportunity to buy properties at a discount, there's so few, especially in multifamily, there's so few of those people that really are having to sell versus the demand of people that can and want to buy, that when, those kind of properties become available, there's just such a huge demand to buy discounted deals right now that it's just so competitive that, we haven't been able to secure one.
Well, I don't know if you've been digging into kind of the vulture fund opportunities, because so many of these multifamily operators, they need cash.
Yeah.
And, doing a capital call is sometimes very difficult.
It's a nightmare.
So the ability to bring in some preferred equity that has some controls if things don't improve is definitely a massive opportunity out there to get bigger shares at a lesser cost,
right? But
really to help everybody.
Yeah. It's definitely a lot of people are, and I'm thankful we only have the two problem projects, and we're going to be able to, a lot of how we've solved a lot of our challenges is just having a good network of investors that, we can put together some bridge loan money or whatever to bridge the gap for a short period of time to get us through the challenge, and then, refinance or sell or recapitalize or whatever. But a lot of people don't have the ability to do that, especially kind of first-time syndicators or people that, got in over their heads, did too many deals, and maybe they had great relationships. They were able to fund a lot of deals because of those relationships, but they themselves weren't really experienced operators, which just kind of goes back to why, we won't work with somebody who hasn't gone full cycle on deal, where we can actually analyze what was the actual result. Why did you achieve those results? Was it actually because of your quality of operations, or was it just luck, or just because the market was great? Anybody could have sold their property. I mean, we sold a bunch of properties when everybody was just willing to pay stupid money and interest rates were, 2%, less than 3%. Man, it was a home run for us. People were overpaying. Everybody made a bunch of money, but that's not what's going on now. It's the polar opposite of that. So I'm glad we were able to take advantage of that when it was going on. But, it's like Warren Buffett says, when people are selling, you buy. When people are buying, you sell. And so, I'm glad we were able to buy what we did, but it's, acquiring new ones, and, this right now, we wouldn't entertain selling any of our properties right now, just because we know that, people are going to expect some kind of discount. unless there's a loan that can be assumed that, is attractive, then, well, maybe, you could sell for reasonable price.
So if I could ask you to digress a little bit to, for the budding real estate syndicator, somebody that wants to be in the business, what advice would you give to them?
First and foremost, good legal counsel.
This is a smart man. That's why you have to listen to him.
I say that, but I'm not joking. Like, I truly, not only did you help legally put the deals together, which has to be done by a securities attorney, but really just having the mentorship, the guidance, the consulting, the problem solving before the problems happen, because you've seen all the problems happen. And, a lot of new syndicators, want to, keep their costs down. And it's the most expensive mistake you'll ever make. You need to have good counsel. You need to have a good team. And you need to have relationships and understand how to treat the investors that are putting your money. For us, our investors are our business. We value them above all other things. If I have to give up a part of a deal or all of the deal, I'll make my money on some other deal. I want those investors knowing that we went to bat for them and want to be able to reinvest and not get greedy. You have to report to your investors regularly, provide them transparency. Don't mix and mingle funds between this thing and that thing that causes all kinds of problems. A lot of times, if a syndicator isn't consulting regularly with professional legal counsel, they have all the good intentions, but then wind up in serious legal trouble because they didn't know or didn't really read the PPM to where they fully understood what you're supposed to do. Because whatever you're supposed to do, it's, I actually didn't know how much I appreciated the way you structured, because although I would read them, I'm not an attorney, but I've since become very good at understanding legal language. I've seen how something's worded in the wrong way and something bad can happen, but also there was all these covenants and clauses and things that you built into these deals that, quite frankly, I wasn't aware of until we started having to go and consult the operating agreement and really saw how they were put together both for the benefit of making sure that the sponsors were protected and the investors were protected. And there was a clearly defined way certain things needed to be handled. And that's probably been the most valuable thing for me being in the business. And, we've done over 100 private placements, a little over $2 billion in projects from, 2000 end of 2008 when, you started. I mean, you've been there since day one to where we are today. So that's my advice.
You want me to give you an amazing statistic? It almost unbelievable. Last year, we represented 425 real estate syndication and investment projects.
Wow.
I believe at this point we've created the largest, by the just sheer number of deals, law firm in America that are doing this. And for all of those reasons why you just explained, we continue to just knock it out the park.
Yeah. Well, I mean, you've been, thank you for everything you've done for us. I mean, you helped shape my career and destiny and make sure that we stayed on track and did the right thing and followed all the rules to the best of our ability. And really, you're kind of like a pissed off, mean uncle. It was always, slapping around the nephew, at least in a business sense. And, but those things, you never pulled any punches. And sometimes, I was like, holy crap, what did we do wrong? But, it was for our own protection. And then as my career evolved and situations came up, I really appreciated more why you did a lot of the things that you tried to do and have a setup the way that we were set up. And we're still in business to this day, and we're grateful, and we will continue doing what we've been doing.
I love it. Well, let's see. How's the timing going? I got one more question for you.
Okay.
What projects are you working on today, and can you actually talk about them? Because there's all those restrictions, but want to hear about.
Yeah, I'm just going to break all your rules that you taught me in the past, Nate.
Man, if you can't talk about it, don't talk about it. But if you can, I'd love to hear about it.
No, actually, I can, Nate, because I listened to you and we're doing 506C, so we can generally solicit.
I love it.
Yeah. All joking aside, even though we do some 506C deals, we don't do a lot of like truly generally soliciting. It's mainly to the relationships that we have. We also work with other co-sponsors and people that work together with us. And as you know, we've had a broker-dealer for a very long time. We're doing all direct issuer transactions now. And so we are doing more marketing and things, and that's the reason why we decided to go with the 506C. But we do standalone deals. We just finished a multifamily deal, but we have a real estate opportunity fund that currently holds 3 properties in it, and we'll generally, and it's a $10 million fund, so we'll generally invest, no more than $2 million in a property. So we should be able to have, a minimum of 5 properties. We've got 3 properties in there now.
Are you co-investing with other joint venture operators?
No, we're investing in, so our fund, we have the fund structure for people that may not want to put $100,000 or $200,000 into, 3 or 4 or 5 different properties, but yet want to be in 3 or 4 or 5 different properties. Our minimum investment is usually $100,000. Like 100 to 250 is the general average investment size. So, if an investor, if that's all they can do in a year, well, then investing through the fund model makes more sense to them, because whatever their investment, whether it be 100 or 200 or 300, it's going to go into all of those properties versus the direct deal. So our fund is an alternate investment vehicle for people that can't invest, because we don't want somebody to invest in one deal. And if all you're going to do is 100,000, and we have a property that we're doing, like this one we just finished, which is called Brook Hollow, with Dixon Adams Group, whom you also represent, and they've been fantastic. And but if that's the only one you're going to do, well, we're going to advise you should probably look at investing through the fund. So we have a multifamily real estate opportunity fund that's open, currently has 3 properties in it, and then we'll wind up investing in those that make sense. So as we accumulate more capital, we're able to take advantage of an investment opportunity. We do have another property that we're looking at investing in, so we'll be able to deploy the money over the next few months. And then we also have been, we've got a great group that does freestanding emergency centers that we have all over the DFW area that you're familiar with. And they've just done a fantastic job. So there's 8 locations that are currently up and running and open and profitable. And then we also have a micro hospital as well. So there's a total of 9. And now we're just going to expand on a proven existing business model. And so we also have a fund that's open and accepting investments now for investors that want to be part of that growth and expansion of that proven business model that we've had success on.
Well, that is phenomenal. And if you're looking for good quality operators, so at the end of the day, it's about who you're investing with and not what you're investing in. Eric Mattingly is a wonderful guy to talk to, always has unique, fun, different perspectives, but at the end of the day, for nearly 20 years, doing successful investments, protecting the investors all along the way. So really just a good guy to know overall. So wanted you to have a deeper dive and a deeper understanding of when you're doing your own due diligence or getting into the investment field. Who should you listen to? What should you pay attention to? And at the end of the day, how you can protect yourself and your investors. And this is why.